Hello everybody, welcome back to The Contrarian. I'm Logan and I hope you're doing well. I'm just making this video as sort of a summary of this past year, 2021. I'm making it sort of in response to a video I just made yesterday about gold and silver and just how much longer these consolidations have lasted in this market, even though the fundamentals have definitely been there for significant rally. And I've just titled this video 2021, the year of market extremes, simply because I think this last year we've really all seen so many. It's not just one individual thing, but there have just been so many examples we could list of extremes that have occurred in the market, both on the upside and on the downside, and just how unprecedented this year has been in terms of the pricing power of the market, both to the upside and the downside. Now, typically in the market, you have forces such as supply, demand, you have forces such as leverage or interest rates, but all of these forces have essentially been put at the most extreme that at least I've ever seen the market right now. And I'm a young investor, but many people who are significantly older than me are also saying similar things. Charlie Munger recently came out saying that this is, the most extreme market that he's ever seen, or something to that extent. Jeremy Grantham as well. These are guys that I really respect, who have a lot more time in the market than I do, for sure, and they see very similar things. So today, for the sake of this video, I'm just going to go through a brief list of kind of the top most significant events that definitely will jog all of your memory. Then I'll go into the reasons why I think these market forces have essentially been put so far to the extremes that they have been. So first of all, starting off in January of last year, we had the beginning of the democratization of trading, and essentially what took place on Reddit and Wall Street Bets and other chat groups such as that is, individual retail traders would band together. They'd decide, okay, let's go after this stock because it has a very high short float. There's a lot of people shorting it right now who will have to repurchase the shares if the share price goes up significantly. So let's buy up a bunch of call options and shares on this stock, irregardless of the fundamentals. It doesn't matter if it's a profitable company or not. We're just going to bid up the price, and that'll force a massive short squeeze and a gamma squeeze, and then we're just going to cash in on that. And that actually did work to an amazing extent. I did not think that that would ever really happen, but we obviously saw that with GameStop, with AMC, and a bunch of other penny stocks out there that essentially were just the most shorted stocks out there in the market that hedge funds and other institutional investors had bet against, and the prices of these were sent up dramatically. And what is almost a little more crazy to me is the fact that, say, the price of GameStop's shares are actually still extremely high. They're about half of the peak price that I think they got to. So GameStop is now trading at, a $25 billion market cap or something, when it's probably justified valuation is maybe a $3 billion market cap. So something like that, or an AMC theater stock, which, without that kind of ability to issue shares at a much higher price, they would probably be bankrupt at this point. But that's definitely the first topic that comes to mind as we go through the year chronologically. Then moving on from there, we could definitely get into the crypto space of cryptocurrencies, oftentimes just complete jokes such as Shiba Inu or Dogecoin or whatever. Those would periodically go into being the next token that people would bid up in price, and then the price of that would go up several thousand%, and a lot of people would get very rich off of that very quick, and then a lot of people would lose money who bought at the top, and then it would go down 95% from there or whatever. And then also there's NFTs. Never forget NFTs, because I thought it was crazy back in May of 2021 when the one NFT sold for $69 million, but then fast forward to October, and then an NFT had sold for $532 million. So $500 million for just a few pixelated pictures of who knows what. Essentially, the price of something that has no intrinsic value is what an extremely high-end house would normally cost. So just extreme market disruptions to that extent. Obviously, moving on from there, we could get into the SPAC issuance explosion that occurred this year, with so many new SPACs coming about, special purpose acquisition companies, essentially a blank check company, where certain people would get together and say, hey, let's issue this SPAC. We're going to build this kind of a company. We'll purchase, these already existing companies. We'll merge them together. And, this had been around before, but definitely not to the extent that it was done this last year, and definitely not at the valuations that these SPACs were oftentimes bid up to. So I would say the SPAC explosion would definitely be another area where we've just seen so much market dynamics happen that I've just never personally seen before, and many other people had not seen before either. And then moving on to the much higher end of the market cap curve, you have a stock like Tesla, which has a PE ratio of around 400 right now, I believe. It's only been profitable the last 1.5 years, essentially being bid up to not only the most valuable car company in the world, but being worth more than all other car companies in the world combined when they make somewhere around 3% or 2% of the vehicles worldwide. It's just extreme examples like this that I give simply to show how extreme the market has been in the last year in terms of pricing power. Now, in the market, we've seen this sort of extreme oftentimes happen to the upside, but what's even a little more strange is in the real economy, we've seen a very weak data come out in terms of jobs reports, numbers coming in. Obviously, we've had a massive worker shortage almost the entire year, where restaurants, retail companies are just struggling to get anybody willing to work for anything less than $15 an hour now. So wages have definitely increased dramatically in the last year. We've also seen, as a result, in part of wages going up, we've seen inflation begin to accelerate again, as well as just weak economic growth, which definitely gives into a stagflationary type of environment in the future. And so bottom line is, we've seen extreme market mispricings to the upside, things that have no intrinsic value or very little value being given almost infinite value comparatively. And then in the real economy, we've seen almost the opposite of just a very weak economy. Not terrible, it's definitely not in the depressionary, recessionary type market conditions, but it's not good, to say the least. So the ultimate question I had to think in my mind is, what gave way to this kind of extreme dynamic that we've seen and that likely will continue going on a little bit longer? And ultimately, I came to several conclusions, and there's a few primary causes, I would say, that have something to do with it, and then one probably root cause that I would say, yes, this has something to do with all of them combined. So yeah, we've seen a lot of increased welfare programs. Maybe there's some welfare programs that don't entirely need to be there right now, that were introduced during the pandemic, but aren't really necessary anymore. So yeah, it's possible that there's some people out there who are just using the system, who are using it to take a lot more risk in the cryptos or NFTs, who normally wouldn't be able to do that. That's maybe part of it. Another part of it might be the regulations, the new administration coming in, putting in some regulations that say in terms of energy costs, in terms of the ability for supply chains to function. Maybe that had something to do with the whole supply chain disruption that we've seen. And then ultimately, the largest reason as to why the market has been so out of whack in the last year, so dysfunctional, has to do with the fact that the federal funds rate is at 0% right now. So money is essentially free to borrow. If you're a bank, if you're a large business, if you're one of the S&P 500 businesses out there, it doesn't really matter who you are. You can go out there and purchase assets, you can do mergers and acquisitions, as long as you borrow money at 0% interest rate. And that essentially means you don't really need to pay anything back to service this debt. You can almost take on an infinite amount of debt. And that gives way to, somewhat 20% of the S&P 500 being zombie companies. I don't know which companies these actually are, but somewhere out there, there's a person who's gone through the S&P 500, each of the balance sheets of these companies and has determined that approximately 20% of the S&P 500, these large companies out there, are actually zombie companies. And oftentimes this happens so later on in the stages of a secular bull market, when a bull market has just been going on for, however long it has now at this point, upwards of 40 years likely. These companies have just been around for so long that they've been able to get away with a lot of activity that they might normally not be able to get away with. And so gradually, unfortunately, this secular bull market has made it possible for companies out there to just accrue so much debt that should interest rates rise even just slightly, they'd have to go bankrupt. They essentially would not be able to service this enormous load of debt even with a 1 or 2% interest rate on the federal funds rate. So ultimately, I do think that this extreme market dysfunction that we've seen in the last year just has to do with the fact that, inflation, it's close to a 40-year high right now on both the consumer price index and on the producer price index, and yet the federal funds rate is at 0%. It's pretty much never been lower than where it currently is. So ultimately, this is a big market mispricing that does have to be reckoned with at some point in the future. This is essentially what has given way to what is currently basically in everything bubble, a bubble in every sort of asset class out there, whether it's the stock market or the crypto space or NFTs where it might be the most evident, but then all the way down to housing, everything else that tends to be a more safe haven type asset. So ultimately, this is why so many people, including myself, are just very, very cautious right now going into the coming years. It's just ultimately this market dynamic has to be reckoned with in a big way. The mispricing between where inflation currently is and where the federal funds rate currently is, ultimately that has to be worked out, and likely that comes in the form of some massive type of correction occurring or the Fed tightening massively, and either way that does cause a big change from where we currently are. But all of this being said, this video was simply to talk about this last year, why it's been so wacky of a year. All of that being said, if you guys enjoyed this video, give it a thumbs up. If you didn't enjoy it, give it a thumbs down. Let me know why down in the comment section, and I hope to see you again at some point.